Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Tesla shareholders approved Elon Musk's $1 trillion pay package, and we had some comments from Tesla General Counsel Brandon Ehrhart. Let's take a listen.
Sixth and finally, on the 2025 CEO Performance Award to our founder and CEO Elon Musk, with over 75% voting in favor, approved.
All right, that's a good day for Elon Musk. That was Tesla General Counsel Brandon Ehrhart. To see what this means for the company, for the stock, let's check in with Stephen Mann. He's Global Autos and Industrials Research Analyst for Bloomberg Intelligence. So, Steve, a good day for Elon Musk. What does it mean for the company here to get this pay package through?
Yeah, he did seem pretty upbeat last night at the shareholder meeting. He was talking a lot about what the future looks like. It almost feels like I'm watching like a Star Trek episode when he talked about robots. I think it's a big relief for the company as well as the shareholders. Looks like a lot of shareholders, given that about 75% voted for the pay package. I think now the company and he can actually start focusing on delivering those metrics, which is $8.5 trillion market cap in 10 years, $400 billion EBITDA. During that time. So there's a lot of things he needs to do.
So those are the very specific financial metrics that he needs to achieve if he wants to get paid what shareholders have approved. But in terms of actually getting there, Musk made some big promises. Humanoid robots will be doing a lot of beyond human precision surgery, for instance, and robots will play a big role in setting up bases on the moon and in Mars. And which of the predictions did he make sound reasonable at this point?
Robotics is an evolution. I think there is still a lot of technical challenges to make the humanoid work just as well as a human. So we're at BI, we think humanoid robots are actually a little bit ways off. But what was really interesting and kind of caught my attention was that he wanted to build, he's currently designing his own chips for autonomy, but he also wants to build his own fab for autonomy. And that's really a direct competition to companies like NVIDIA and some of the fab companies like TSMC. Now, his chips are a little bit different. It's a special purpose chip. Where NVIDIA's AI chips are made to accommodate many AI applications. His is specifically for autonomy, like robots and cars.
All right. The math I do is, in order for Mr. Musk to achieve his full $1 trillion in comp, the market cap would have to get to like $8.5 trillion. It's at $1.5 trillion now. So that's incremental $7 trillion in market cap he thinks he can create. And if he wants to take $1 billion of it, that's fine with me. I'll take the rest. And I think that's kind of what shareholders were saying with 70% of them, 75% of them are approving.
$1 trillion, you mean?
Yeah, for $1 trillion. So, if he's going to make incremental $7 trillion for shareholders, he can have $1 trillion as far as he says.
But look, remember, he's not taking the cash. A lot of it is just his stock, right? At the end of the day, he just wants greater control over the company, 25% control of the company. But he has to deliver.
Yep, has to deliver. So how do we think about this, even the car business now, Steve? It's almost an afterthought for this entire story. How are investors thinking about kind of what is the core business today?
Look, I think, you're right. A lot of people think cars is an afterthought, but I actually have a different view. What he's really trying to achieve is physical AI. Quite different than what Google is doing or ChatGPT is doing. He's actually creating AI through cars, mobile devices, cars, and robots. So, for him to proliferate autonomy, physical AI, he still needs to produce cars, right? I don't think he's going to license the full self-driving to any other automakers anytime soon. So for him to proliferate autonomy, he does have to produce cars. Look, and then that's why he's also very focused on, improving the design of the Optimus robot, so he can actually, build more and sell more to the market.
Yeah.
So cars is important still.
That's the understatement. Cars are still important.
I'm almost like spin out the car business and just have
that may very well happen.
And just have the rest of it is kind of, this is
the
Elon
business.
Inc. This is Elon Inc. If you want to buy into all the stuff about Elon, then here's your way.
I'm so glad you bring that up, because there was also Proposal 7 that was voted on at the shareholders meeting, Steve, where it was a non-binding request for the board to authorize an investment in XAI, which is essentially Elon Musk's side gig, right? The company that holds X as well as the Grok chatbot. That gives the board the option to invest Tesla's money into XAI. What does that tell us about where Tesla's headed as a company?
It's an interesting proposal. And look, they are going to still kind of take some time to think about that. But it's all interrelated, right? A lot of the stuff that he talked about last night about autonomy, Optimus robot from Tesla, and how those robots can be used in Mars, they're all connected. All AI is connected. So, does it make sense for Tesla to invest in XAI? Yeah, I think there's a lot of technology that can actually be shared between the different AI platforms. And currently, if Tesla vehicles do come with Grok, which is part of XAI. So if vehicles are autonomous, Grok would and other assistant would be very useful in a vehicle for the passenger.
We have a listener question coming in. Ryan from New York City asks, what's the likelihood Tesla can compete on the global level versus Chinese robot companies? Maybe it's the leader in the US, but where does it stand versus those in Asia? We actually published a report on humanoid robots, but specifically on auto manufacturing. What we've learned is that Chinese are very, very far ahead. They have a number of startups working on humanoid robotics, trying to improve dexterity, trying to improve the technology stack. It'll be interesting to see, and I think some people have written out the Chinese, but the fact that they have a lot of investment and a lot of startups looking at this, they'll be a formidable competitor.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Are you a gamer by any chance?
God, no, but my children are, and that irritates me to no end.
Does it? So are they do they
on
care
their phone usually?
Okay, so this Grand Theft Auto thing, for people, I guess it's a piece of news, right?
Yeah, no, it's a big deal because this is something they've been working on for a long time. And this is the sixth part of the franchise, the sixth iteration of it. And it's supposed to take place in Miami, but a fictional version of Miami. And it's supposed to be like the hot game when it eventually comes out. That's the issue. We don't know whether they're going to meet their deadline, and they've delayed it twice.
All right, let's talk to somebody who knows this stuff for a living, I guess. That's the best we can do here. Nathan Naidu, technology research analyst for Bloomberg Intelligence. He joins us here. Grand Theft Auto postponed again. Take-Two, the stock is down almost 9% on this news here. Nathan, what do you make of it?
Yeah, so that's a good point there on the GTA or Grand Theft Auto 6 iteration being a big factor actually in today's sell-off. And I think, GTA 6, let's call it in short, has been, the prospects of it rather has been priced into Take-Two shares. And last I checked, Take-Two is trading at about 60% premium to the only other big US publishers, Electronic Arts. And that's a 60% premium and even higher compared to an average of about 10 peers. And so, valuations and expectations were high up until that point. So obviously, valuations were going to be a bit sensitive to any sort of downside risk. And as we have seen today, is the delay of GTA 6. But I don't think this second delay officially is necessarily going to do any more impact than the first delay, because the first delay actually skipped the holiday season. This time round, it pulls the launch timing closer to the holiday season, and actually a season that usually see a lot more activity on the player side.
Okay, yeah, to your point, the original release date was back in fall 2025, then it was delayed until May 2026, and now it's been delayed by another 6 months to November 2026. Nathan, I'm going to ask the dumb question. If they delayed it twice, they might delay it again. Why are they delaying this game? What's proving to be difficult or problematic about this?
Yeah, so according to the words by the company themselves, they want to give the developers rather a bit more time to polish the game. Game like the GTA, GTA, to take a step back, Grand Theft Auto is easily the top 5 selling games franchise of all time globally. So this game has quite a bit of a cult following. It has sold more than 450 million units, right? And so I think it doesn't make a big difference whether it's delayed, in this round of delay, because this game, regardless of when it is launched, is gonna bring back those core loyal fan base, and we're talking about 15 to 20 millions of people playing GTA 5, the current version, every month. So that proves my point. And also, launching in November, which is the high sales season for any sort of video games or any sort of products rather, is actually a better timing, and it might work in GTA 6 favor in the end, I think.
All right, Nathan, in your world of online gaming, can you size out how big this business is? Because I think a lot of people don't have a good idea of just how big the gaming business is. I feel like
it's bigger than Hollywood,
yes,
right?
So
bigger than the movie business.
Exactly. How big is it, and kind of what's the growth parameters for this industry?
Yeah, so the overall video game market is inching towards like 180 billion US dollars in sales last year, and that is actually bigger than films and other easily, right, other entertainment forms. And GTA, if we assume that if we assume that the GTA 6 sells about 35 to 45 million units, that's about 2 to 3 billion US dollars in upfront revenue to the company, and that's just one game.
Men aged 18 to 49.
Oh my god, it's just
the advertiser's dream.
Is I guess, yeah.
Yeah.
I mean, does Pong count?
No, Pong doesn't count. Sorry, right. No one's monetizing off Pong anymore. Nathan, do you know what Pong is?
Yeah, you mean like age cohort?
No. Okay, no. We're showing our age now.
All right, so Nathan, for Take-Two, what's the is that just really a play on Grand Theft Auto? Is it
Good question.
That dependent on that game?
Yeah, so Take-Two actually has a few other big franchises under its belt, like Red Dead Redemption, for example, and Take-Two is also big in sports game, whether that's football, and so GTA is certainly the biggest game, but it's not the only pieces of the puzzle in terms of how it is driving Take-Two top line as well as bottom line. But it is certainly going to be the biggest game launch next year, and that's coming from Take-Two. And given the game is actually in-house, meaning it generates a lot more to bottom line than games that are based on third-party intellectual property where a royalty payment is involved. So we can expect a significant boost to Take-Two's profits as well next year. And actually, the company is expecting to generate positive free cash flow again, because they're currently running on negative.
Okay, I have a question here because usually when we talk about Take-Two, I look at how the other video game publishers are performing. And right away I thought, oh, check EA. EA is barely moving, but that's also because EA is going to be bought out by private equity. Is Take-Two a candidate for a buyout?
So Take-Two is certainly a good candidate, and it is actually it would be the only other surviving US game publisher of scale if the EA deal actually completes and goes through. And EA is expecting that deal to close in the April to June period next year. And EA is a good candidate because it has a robust sport franchises, and obviously Grand Theft Auto is a game that has survived more than 2 decades, and it continued to attract millions of players, actually, about 15 and up million of players every month. So, with attention increasingly being scarce, games that continue to perform well actually are games that were published 6 years or earlier. So there's actually not a lot of room for brand new games to grow in this market. In fact, Newzoo actually mentioned that for brand new titles, only 8% of the gameplay hours are up for grab. So, that just says like, well-established franchises with a cult following certainly has its value. And we actually saw Tencent's investment in Ubisoft, a French game company, and Tencent obviously needs no introduction, is a tech giant in China and certainly a giant in gaming. Yeah, they invested about a few billion euros to take a quarter of a subsidiary of Ubisoft that actually owns a quarter of Ubisoft 3 most valuable franchises. If you like ninjas, assassins, we're talking about Assassin's Creed here. We're talking about Tom Clancy and a few shooter games. So there's definitely a general direction of companies with resources eyeing companies with great IP if those two do not currently exist together. And we certainly see that EA deals coming through kind of plays into the Saudi ambitions for esports. And Saudi Prince, which is the chair of the Sovereign Wealth Fund there, is actually an avid gamer himself, and which I suspect is one of the factors behind why EA is a good fit for the deal, because EA has the most popular soccer game out there. Well, I say soccer because I'm in Europe right now. I need to differentiate from football.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Wendy's, I guess the way Bloomberg News is reporting it, they reported better than feared 3Q results. So there's some concern out there about the consumer, particularly on the lower end of the consumer, and how that's impacting various industries, including the food industry, the restaurant business. And so we want to get the latest on what's happening out there in the world of food and restaurants. We go to Mike Halen. He covers the restaurants for Bloomberg Intelligence. Mike, talk to us about Wendy's. What did they say on their call? What did you learn with their results? And by the way, I'm a big fan of the Baconator.
Yeah, Baconator's great. Chicken's great. Historically, Wendy's has been known for great food, but their food has suffered especially in the last year or two, mainly because the previous management team, who I said in a previous interview, lit this company on fire and then headed for the exits like George Costanza in Seinfeld, knocking over women and children on the way. And what they did was just flood the system with LTOs, and it didn't give people
flood the system with what?
Limited time offers,
okay.
LTOs.
Okay.
And every 2 weeks there was a new offer, a new value meal, a new food item. And it didn't give them ability to market it correctly. And people would come in and thinking they were going to be able to get one item and they'd have to switch to something else, right? And it led to complexity in the store, poor operations, which led to poor food quality, poor customer service down the line. So this company had a tough quarter. It's going to have a tough fourth quarter as well, but a lot of it is self-inflicted. They did speak about, their expectation for low-income consumers to continue to be pressured in these next 2 quarters.
So I know for McDonald's, the vast, vast majority of their stores are franchise. Is that the case for Wendy's as well?
Yeah, that's the case for Wendy's. One of the things that they mentioned on the call is that they're going to be closing, roughly 5% of their store base in the coming quarters because franchisees have been have not been performing very well, right? Sales have cratered, and when there's a lot of operating leverage in this model when you're a franchisee. So when your sales decline, your margins decline even faster. So, they're going to be closing a bunch of stores, but we think that could actually accelerate the turnaround, right? So as they close underperforming stores, this should boost sales at the surrounding locations. And management has a pretty good plan. There's not a whole lot of, they still don't have a permanent CEO, and there's not a lot of restaurant experience at the top. The interim CEO was the CFO who came from outside of the restaurant industry. But we think he's pushing the right buttons. I think hiring Greg Creed, who was the previous CEO of Taco Bell and then Yum Brands, arguably the QSR GOAT, to do some consulting work, I think is a really good move. I think that's really going to help their marketing. And it's a great brand that has a lot of things it can market from the past, like where's the beef, you know? And they're doing a lot less LTOs, and they're going to work on fixing the operations. They're spending money on training, doing things that we think can really make a difference in 2026.
The hamburger business has changed a lot since I was a kid, when it was basically, McDonald's, Burger King, then Wendy's came along. That was kind of it. Now you've got all these, I don't know what you guys call them, specialty burgers like Smash Burger, Five Guys, all that kind of stuff, Shake Shack. How's the burger business these days?
Man, people love burgers, but you're right. It is a saturated market with all of those burger better chains. I think it's good for the overall industry that Wendy's is closing some stores. Jack in the Box is going to be closing some stores, right? Like, to me, this is a part of the restaurant business that's oversupplied, and it's been growing faster than population growth. And so to see some chains start to close some stores, we think that's healthy, and we think it's going to improve results in the future.
How's the burger business been impacted by the cost of beef? I've been reading that, beef costs have been elevated for a while now. So how are they dealing with that?
Beef costs are a killer, especially if you're not able to drive traffic into your restaurants. So for Wendy's franchisees, it's been absolutely crushing for them, right? They're more than 95% franchise, so the corporation is going to take a hit on the 5% of stores or so that it owns. But most of the inflation and the margin compression is going to come on the franchisee side, and they're the ones that are struggling, and they're the ones that are going to be closing stores.
Where's the best value in your universe of restaurants, Mike?
You talking about
the stocks
valuation?
Yeah.
Well, this one is interesting. Right now, it's trading at 10 times 2026 EPS, right? Yep. And historically, these names trade at 15 to 30 times. Really? Because being a franchise chain, it's very easy to predict your earnings and your cash flow, right? And they're insulated against inflation. So historically, it's 15 to 20. So we think at some point when, ahead of the sales inflection that we think is likely in the first quarter, that investors could look more closely at this name.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.